Now it's time for Development Debates, where we dig deeper into some of the questions shaping the future of China. Today we'll take a look at a proposal to turn part of the now defunct Ministry of Railways into a publicly traded company. During this year's annual legislative sessions, the Ministry of Railways, once called the last fortress of the planned economy era, finally met its end. As part of a government reorganization, the ministry will be split into two arms. Regulatory power will go into a bureau of the Ministry of Transportation, while operations will pass on to China Railway Corporation. That corporation still hasn't taken shape, but many anticipate it turning into one of the country's most powerful state-owned enterprises. How that company will end up doing business and what it plans to do with the ministry's nearly $500 billion in debt remains up in the air. Phoenix TV cited Gao Hongfeng of the Ministry of Communications, saying that China Railway Corporation would fully undertake the former ministry's 2.6 trillion RMB debt. That represents a huge financial burden for a company that will allegedly be run along more market-based lines. How to deal with and digest that debt? Some officials are optimistic that with the ministry's abundance of good assets, the debt could become merely one aspect of a profitable, publicly listed company. That claim has been met with skepticism by economic commentators who worry about the effect of a politically connected bureaucratic behemoth on the stock markets. The question of how China Railway Corporation could fare on Chinese stock markets largely depends on how those markets function themselves. Respected economics commentator Ye Tan recently took Chinese stock markets to task for operating on the basis of politics rather than profits. She credited the stock markets for playing a role in reforming many of the largest state-owned enterprises, including banks. But Ye argues that the markets fundamentally fail to properly price assets and give shareholders a voice in company operations. She wrote on her blog that despite giving the appearance of reform, SOEs never truly turn into public enterprises that would allow shareholders to participate in company management. Instead, SOE and government officials precisely engineer stock offerings to serve as pre-staged cash infusions for favored companies. This serves everyone well for the time being, but in the long run it undermines the very rationale for stock markets. Ye Tan put the question starkly in a blog piece for Caijing's website. Quote, "The key question is, in the end, what kind of stock market do we need? Is it the kind that takes orders from those with power, a market that bestows capital but doesn't pay out interest? Or one that creates a mechanism for survival of the fittest, that offers a steady stream of power to help enterprises reform?" She went on to argue that in the breakup of the Ministry of Railways, the Chinese government has put itself in an awkward position relative to the China Railways Corporation. By creating the company out of its own assets, the government has effectively endorsed it and will likely to continue to lend it support, creating a whole range of issues. The presence of that kind of company on stock markets will continually raise one uncomfortable question. Are investors supposed to evaluate companies on the basis of their business fundamentals or on an estimate of what kind of profits they can derive from friendly government backers? We'll have a better idea of the answer to that if and when the China Railway Corporation makes its stock market debut.